Good morning, and thank you so much for joining us.
Good morning, and thank you very much for having me, Alexandra.
So let's kick off with a Fed meeting tomorrow. What are your expectations, and of course, what would you like to hear from Jerome Powell and co?
Well, I would like to hear Jerome Powell to take a more flexible approach to tapering than the Federal Reserve would have done in the past. You see, the problem that the Fed is facing now is that it's trapped. Whatever decision that is going to take is gonna go bad either way. Because if, for example, Powell pushes back on the market pricing earlier interest rate hikes, well, on that point, break-evens would start to rise again. But if he basically accepts that there is going to be earlier interest rate hike, that can move the front part of the yield curve. So at this point, we believe that the only thing that the Federal Reserve can do is to basically give the market what it wants, which in this case is tapering, but keeping a flexible approach by saying basically that it will be more aggressive or less aggressive in tapering depending on how the situation evolves from here until June next year.
What we're seeing on the bond market is really interesting, and I was wondering what's signaling the market in your opinion?
Well, it's actually very hard because in the front end of the yield curve, the bond market is obviously signaling the beginning of an interest rate hike cycle. And that's quite interesting because it's doing so without any kind of hint from the Federal Reserve that is going to happen. However, the long part of the yield curve is remaining stable and is indicating that there might be some troubles ahead. So it's a very difficult environment, Alexandra, to take position at this point because things can go either way. And I want to highlight, especially on the long part of the yield curve, we noticed that on the TLT, which is the iShare ETF that tracks US Treasuries with maturities from 20 years onwards, that the short open interest on TLT is at record high. It means that if something goes wrong, if there is a surprise, basically there could be a short squeeze within this space, which could pressure yields lower on the long part of the yield curve.
Do you think that the Fed is behind the curve actually?
Well, that's actually an interesting question, and we believe that the Federal Reserve has been behind the curve for quite some time. We have seen around the globe several central banks taking a more hawkish stance, and with inflation being so high, and with these many signs that inflation might not be temporary, as they have been saying until now, we believe that tapering should have happened much earlier than basically this month or next month.
On the other hand, it's pretty interesting what we see on the European side, also when it comes to the spread between the 10-year Italian and the 10-year German, 125 basis points, but we saw it yesterday above the 130 mark, which is certainly pretty interesting. And on the other side, specifically the 10-year Italian at 1.94, but it was at 1.30 in just a few minutes ago. So I was wondering, what's your take on European bond yields, and specifically what is the 10-year Italian signaling in terms of monetary policies?
Well, I think that the answer to that question is fairly easy, in the meaning that we can expect European sovereigns in general to continue to be volatile, at least until the next December ECB meeting. And the reason for that is that it's obvious that the central bank is concerned about inflation. It has been quite obvious last week, and inflation will ultimately drive monetary policies. However, what is happening here is that, especially to your question regarding Italian BTPs, is that, of course, if we have a more hawkish ECB, if let's assume that the central bank is ending its PEP program, as it already said, by March 2022, and doesn't adopt another program that allows the same flexibility that it had under the PEP. That is obviously a big negative for the periphery, so Portugal, Spain, Greece, and Italy. And that's why we have seen a huge volatility since the Thursday ECB meeting until yesterday. Yesterday, the sell-off, we believe that has been taken too far, for the simple reason that in a lot of European countries, it was a holiday, a bank holiday. And basically today, investors have been going back to their office and they've been purchasing basically those assets that now were providing a much higher yield than Friday last week. So this is how we explain the rally that we're seeing today.
That's pretty interesting. Can we imagine like this higher yields trend to environment to continue until the end of the year?
I would assume that it can continue until the next ECB meeting, but we cannot forget that one of the key drivers of ECB monetary policies is to keep favorable financing conditions across all European countries. And Italy is obviously one of the biggest the economies that they have at their hands, and they want to continue to provide favorable financing conditions for that country as well. So basically, what I'm trying to say, Alexandra, is that there might be volatility from here until the December meeting, but if the BTP Bund spreads continues to widen, and let's say widens to 150 basis points, which is actually a spread that has been signaled around among other colleagues in the sector, well, at that point, the ECB cannot ignore the volatility in BTP sovereign, in Italian sovereign bonds, and will need to intervene to guarantee favorable financing conditions. So what I'm saying is that in December, there could be a dovish surprise rather than a hawkish surprise from the ECB that would compress the BTP Bund spread.
That's pretty interesting. Final take. Let me take a step back and go back to the Fed. Of course, we're going to see the press conference tomorrow. Do you think that they're going to finally announce something? Because at the same time, we're going to see the non-farm payrolls on Friday, which are going to be certainly extremely important for the Fed. So that's for sure. So do you think they're going to announce anything that could be important, which is certainly the start of tapering? We're not talking here about rate hikes, or at least until the end of 2021.
Well, of course, they're going to announce a tapering. The Federal Reserve doesn't like to surprise the market, and it has been communicating fairly enough that is going to taper around this time. So definitely, if it doesn't taper, it could cause more volatility that it intends to. So that's going to be the bigger announcement. But in regards to the non-farm payrolls, the number of jobs added to the economy at this point is quite irrelevant. And we discovered that in the past few months, because we had 2 consecutive months in which non-farm payrolls disappointed quite badly, but the Federal Reserve stuck on its point that is going to taper soon. So the thing that we believe is still relevant for the non-farm payrolls on Friday is inflation. We want to see if wages continue to rise and stay strong, because that's basically a clear indicator that inflation could be more permanent than central banks wants us to believe, and therefore inflation is going to drive monetary policies going forward.
Thank you so much, Althea Spinozzi, Fixed Income Strategist, Saxo Bank. Thank you for joining us. Have a great day ahead.
Thank you very much, Alexandra.